You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding Options Insider Radio Network. Many more programs planned heading down the pike toward you, listeners, as we speak, in addition to, of course, this fine program, Volatility Views, and all the other fine programs you can find on the old network. Where can you find those? Well, pretty much everywhere audio is available online and elsewhere. You want to go over to iTunes, Stitcher, Aha Mobile, wherever you find your podcast, you can find our programming there. Of course, you can find it at theoptionsinsider.com or at a lot of our partner websites as well, all the partners we work with on these various programs. And in addition, there's a new place you can find it. It's been around for a couple months now, but pretty exciting stuff. The Options Insider Radio Network mobile app. You can, of course, instantly stream or download all of your favorite episodes of Volatility Views, all 100 plus of them now. There's quite a few out there in the archive, a substantial archive of great guests. Listeners, if you haven't had a chance to go check out some of the archived episodes, some of our archived interviews, some of those guests, check them out. They're really, not to toot our own horn, but they are pretty impressive. Of course, while you're doing that, you can always tweet at us. You can shoot us a Facebook question. You can shoot us an email question. You can even leave us a voicemail all through the app. It's really cool stuff. Check it out. The Options Insider Radio Network mobile app, available for iOS, Android, and the Fire OS. All right, and joining me on the old program today, starting off with the man who was somewhere between rural Virginia and deeply urban New York City, Mr. Jared Woodard from BGC Partners. Jared, welcome back to the show, sir.
Thanks, as always. I'm happy to be with you.
So are you in Virginia? Are you in New York? Are you maybe in Chesapeake Bay? Where are you?
I'm in Central Virginia, sitting with some boxes and paper plates and getting ready to make the change.
And also joining us on the show, taking a break from feverishly rolling his VIX positions, none other than the Rock Lobster himself, Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, thanks for joining us. Glad you can take a break from all that feverish rolling.
Yeah, it was the feverish rolling needed to be done yesterday. I got some, but missed some. I think, things are going well. It's sunny in Maine. We right now, as usual, I'm missing my best tide to fish, but I don't mind because for some reason the listeners want to hear more and more about volatility, and we are going to give it to them.
If ever there was a week to forego some fishing to discuss volatility, I think this is it. So without further ado, let's get right to it and dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, welcome to the Volatility Review. This is, of course, the portion of the program where we break down what we saw, what caught our eye the week that was from a volatility perspective, and what a week it was from a vol perspective. We are recording this, of course, listeners, on Friday, July 18th, and as we're recording this, we're in the midst of a bit of a rebound off of yesterday's interesting developments. Most of the major indices closing up or trading up nearly a full percentage point on the day. VIX cash taking it on the chin, down about 2 handles, trading right around 12.35 right now. But that one number there belies the story we saw throughout the rest of the week, and what an interesting week it was. We had quite a range this week, probably one of the biggest ranges we've had in the VIX cash, certainly this year. When we've been doing this show, every time we come in, we check on the VIX cash, and it's always moved a point or two maybe. This week, we had a range of about 10.5, 10.59, all the way up to nearly 15.5, 15.38 on the upside. So a crazy range. And of course, if you've been paying attention this week, listeners, a lot of that movement came yesterday on Thursday, where we had just a convergence of a lot of very dire news all at once. We had the ground incursion going on over there in Gaza. We had the plane crash. Was it a plane crash? Was it shot down? A bunch of other news just kind of all piling in at once and sending the market really into a tailspin. And as a result, when that happens, VIX tends to pop. And we saw VIX do exactly that yesterday to the tune of essentially a 32, almost 33% jump yesterday in the VIX cash. It gapped up to close at 14.54. Got as high as in the 15 range intraday. It's the largest single day jump we've seen in over a year. And that's interesting because it came on the heels of the day before we saw the July options out there in VIX go out. They settled at essentially a 7-year low. A print of 11.03. So talk about a dichotomy just in the 2-day period, settling out at essentially the 7-year low in the VIX for the options perspective. And then the next day we gap up, and the biggest 1-day jump in this year at least. So all sorts of crazy stuff going on this week from a VIX cash perspective. So let's start there, as we are wont to do. Mr. Woodard, a lot of grist for the mill this week from a VIX cash perspective. So what caught your eye amongst the myriad developments going on out there this week?
Yeah, I mean, this was kind of a notable week. We had just been I think, getting comfortable with looking at single stocks and individual stories, and suddenly, world events are back on everyone's radar. I think that the response in the rest of the world was a little bit stronger. You had moves in the currencies and emerging market stocks, obviously in anything in Russia, that were much more notable than what we were seeing in the U.S. In my feed, my stream this week on Thursday, it was a question of whether we'd get that 1% down day in the market or not, and eventually that happened. And I think that's something that everyone had just been looking for, and then they decided to turn around and buy that dip today. So kind of a textbook move, even if the events that caused it were surprising.
That 1% level, Jared, is an important one. The S&P dropping 1.2% yesterday, so it closed off over 1%. That snapped the 62-day streak of neither rising nor falling 1% to close on the day. That's the longest streak of that type since 1995 for all of you stats hounds out there. I know there are quite a few of you listening to this show. So when we've been talking for a while, but not a lot of realized vol in the S&P, not a lot of volatility in the marketplace in general, that's a good stat to back that up. Of course, a lot of activity in the VIX cash, Andrew. A lot of also interesting stuff in the VIX futures. I know you've been watching a lot of interesting developments. Earlier last week, they were crushing the nearer term of that curve. That seems to have changed a little bit. So what caught your eye out there in VIX cash land this week, as well as the ever-evolving saga that is the VIX futures term structure?
Yeah, so we saw that term structure yesterday on the close was, everything. I think we had the first 2 months underwater. Mark beat me to the blog yesterday, but, normally when I think, when the market tumbles like that, once we kind of get backward that fast, there's a lot, basically that means there's people with long vol, or, they owned Index Gamma or Index Vega, then they start selling their VIX futures to hedge. So they weren't really looking for a lot more upside into the close for volatility. They actually, I think, were selling it, as much as they could get away with without getting shorted. So like in our strategy letter, we closed all of our long vol trades. We actually added some short VIX call spreads. And today we got exactly what the futures predicted. Vol came in. I didn't think it would come back to 12 as fast as it did, but it certainly looks like it's going to, because ultimately, the things that have happened are just continuation of what's really been happening. Unfortunate as they are, it's not enough to rock volatility. Again, remember, volatility, in order for vol to trade higher, the expectation has to be for sustained movement. And when you get a pop like that, it's easy for volatility to go from basically year low levels to a much higher level fast when the liquidity providers don't want to sell it. And one thing that's happened as the market has become more electronic, things move much faster. So they get out of the way super quick when that outside offer for volatility dries up. So, yesterday was classic. They just let it go until they found a level where sellers were. That looked like around 15 VIX on the close, something like that. And by today, with basically classic, when there's no new news through the weekend, the volatility sellers come in and they just pound away at those out of the money options, which brings the volatility in. And that's what we had today. So the VIX futures did their job. A pretty good tell yesterday on the close through the last hour, and that's what we got. And where are we next week? It will take a while to get down to the 11 handle in VIX, but that's kind of where we are. It'll probably take a couple days next week if nothing really happens. But, here we are again sitting at 1975 for the SPX, just seeing what will happen. And for the most part, I think corporate earnings have been much better than expected. You're looking at Google, you looked at Intel, like old school stuff, the banks, all that stuff painting the tape over the last month about how the banks are never going to make any money again, trading. Everybody was feeling real bad and sorry for them. And somehow if they could ever stop settling with the government, they might actually start being able to keep the money that they make lately. So, but that's where we are. The earnings part of the equation looks pretty decent. So, can we go down again? Sure. Unless something really awful happens in the Mideast or Ukraine or something like that, we'll probably see lower volatility numbers again. And the term structure today is actually starting to get a little bit back to normal. Yeah, we have, again, that August future I think is a little light, but it only has, 4 weeks to go until VIX expiration, I believe. It's in one of those other, nope, it is 4 weeks. So here we are. No, 1, 2, 3. Yep. We still have 4 weeks to go. So it's not 4 weeks. Here we are today. It's Friday. Sorry. 1, 2, 3, 4. It's 4 and change. It's a slightly longer one. So that future premium is a little light. So, expect VIX to fall, but the volatility products not to follow too much here over the next couple of days. They're going to move slow if they move at all.
You're right. It does seem kind of off kilter a bit to be discussing things like corporate earnings when people are actually dying around the globe. But that is what the market is focusing on a day like today, when you're right, everything else is dramatic and it's terrible, but it's not entirely out of the realm of what we've been seeing over the past few years and past few months, even in some of these areas. So in contrast to that, we do have indeed a lot of good earnings. Google up $20 today in the wake of their earnings. We had discussed yesterday on the option block, seemed like the premium sellers were going to win that one. Seems like the premium buyers got a little bit more of a tailwind going into today's session. It's funny, Andrew, you said that you guys took the opportunity yesterday to put on some short call spreads out there in VIX. You're not the only ones fading the rally yesterday. And we're looking at the options activity yesterday in VIX. The biggest trade of the day was actually a fade of the rally. Someone came in and sold nearly 18,500 of the Aug 15 25 call spreads of 61 cents. So he said, hey, I'm taking advantage of this crazy spike, and I'm going to blow out nearly 20,000 of these upside call spreads. Again, that could be a hedge against something else, and VIX it usually is, but standing in and of itself, it is indeed a pretty tremendous fade of that rally. And so far, well done to this guy. He's looking all right on this spread. We also saw, and he wasn't, of course, alone. There were other people coming into VIX, and they were perhaps buying what the market was selling, the people coming in and buying upside in VIX. Like you do see that on days like yesterday, and we saw it again yesterday as well. Nearly 18,000, 17,257 of the Aug 18s going up. Someone gobbling up those for nearly 50 cents. Let me do a quick rundown here of how those are looking right now. Oh yeah, they're at 40 and they're 30 at 40. So not looking too good on that trade so far, 17,257 times. You can do the math at home there, listeners. Also saw a pretty sizable longer-term spread, buying longer-term, selling the near-term. It was an Aug 22 call spread, went up 12,000 times, buying Aug, selling Aug, doing that for 45 cents as well. So some interesting stuff. Again, some more straight-up stuff, buying 10,000 of the Aug 14s, going up for $1.40. Those are trading, at 90 cents right now. So do that math, listeners. 50 cents, 10,000 times. That'll leave a dent in your wallet. Aug 18s, they also went up for $1.01, 10,000 times. Someone bought 10,000, turned to the downside this time. Actually, some put action for a change. Buying 10,000 of the Aug 12 puts for 60 cents. Those are looking a little bit better. Again, the ball crush is coming in, so they're still about where he bought them, so he's not looking too bad on those. And then someone came in selling some upside, selling the Aug 21 calls nearly 10,000 times for 25 cents. Looking at what we saw in terms of net changes out there yesterday too. That's always fun to watch on a day like yesterday, see what people are macro putting or net putting on, taking off. The biggest changes in open interest we saw actually came in the VIX Aug 16s. So some near-term upside. Let's hope. I'm going to be charitable and say people are up there taking the opportunity to sell that. But of course, probably, as we all know, listeners, probably a lot of buyers in there. Nearly 70,000 new positions open on that strike yesterday for a total of 203,000 net open on that strike. The Aug 32 halves, talking about pretty sizable out of the money. 40,000 of those. I'm going to assume there was a sizable spread out there. Hopefully that was selling the Aug 32 halves. That's against open interest of 62,000 already on that strike. And then Aug 13 puts also putting on some numbers yesterday, adding 32,000 to that mix as well on open interest of 160,000. So people mixing it up across the board. I'm going to be charitable and hope those Aug 32 halves were not all 40,000 opening buys, because if so, those people are not too happy right now. Those are at a nickel on 65,000 open interest. That's a painful thing. And then what else? Oh, yes. And then net, looking back as we've done the last few weeks. Oh, really quickly on the net changes we saw on the day yesterday too out there in VIX land. As VIX, very call heavy as usual, and no surprise yesterday being also call heavy, perhaps even more so than normal. We saw about net change of 381,000 contracts, 277,000 of those being calls, and only 100,000, a scant 100,000 being puts. Really quick, looking at some of the largest, most active strikes we saw out there these days. Still the SEP 19s leading the charge, 281,000 open on that strike. Again, that's part of that sizable spread I believe we saw a month and change ago. SEP 14s, a lot of SEP positions open these days. Still is number 2 space with 220,000 roughly open. Then you got to get to Aug. You got to go down to number 3, 212,000 open of the Aug 15s, 203,000 of the Aug 16s, and 185,000 of the Aug 20s. The only real sizable put strike out there is the Aug 13 puts. Again, we just talked about those. There's 158,000 of those open on that strike. So interesting stuff. Not surprisingly, very, very call heavy in VIX land, as we've said before. Really quick, we did see a little bit of action also out there in some other products like RVX. We saw some calls, Aug 28 calls going up yesterday, as well as some SEP 25s, but not a ton of paper. It seems like most of the action yesterday, even though there was some activity out in Russell land as well, obviously, it seemed like most of the activity was focused on the mothership, the VIX, and the SPX. Looking at the big positions out in RVX, still the Aug 30s. Way upside, 200 of those open, and then it kind of goes down from there. 100 of the Aug 32 halves, and they're so on and so forth. All right, of course, VIX wasn't the only area of the marketplace experiencing some drama, some action, some volatility. We like to touch on the energies out here as well, and some of the other commodities out there, and crude. Also having some interesting activity. In fact, as we were recording this show last week, it seems like something always happens while we're recording the show. Crude was in the process of setting myriad records. In particular, the Brent crude was just lighting up the tape. We saw a lot of trading volume records going up last Friday, the 11th, to the tune of 101,000 contracts going up on NYMEX Brent. The first time ever that contract has surpassed the 100,000 contract milestone. We also saw a new trading volume record of 137,000 contracts going up compared to the previous level of 112,000. ICE also setting records of 1.45 million contracts going up in their Brent contract as well. So Brent was just lighting it up, and then we've seen some vacillation since then around these levels, hovering around a little bit south of, a little bit north of that 100 level in a lot of the crude products. And of course, going into yesterday, we saw crude spiking up a little bit again. Yesterday, of course, a lot of the drama of yesterday coming out of the Middle East, and whenever that's the case, crude's going to take it to the north, and we saw that a bit yesterday as well. It was up about $1. It wasn't too much out there in the NYMEX crude, trading above some resistant levels right around 101.60, 101.80 or so. Reached an intraday high of about 102, nearly 102.70, and then it came off of those intraday highs. So perhaps like what we've seen earlier with some of the ISIS moves as well, an initial spike and then crude kind of coming off those highs. Was that your take as well there, Jared, for what's going on out there in crude?
Yeah, it was. I mean, I think there was that initial reaction driven by the news, but the fundamentals haven't changed. I mean, some of these things in Russia could become significant, but they're not yet. I mean, we looked at the energy space in terms of what different projects, different U.S. and other Western companies had going on in Russia, and whether the events there would affect those projects, whether that would impact, energy more directly. And the takeaway was that, there's a lot at stake, certainly for some major U.S. companies in the region, and probably for that reason, I think that's why we've seen the sanctions be as complex and as targeted and kind of detailed as they are, rather than some kind of broad brute force move. I think is probably partly driven by the desire to protect some interest in the region, and so to the same extent, I wouldn't expect to see a really big move in the energy products off of these events until something got, unless something got really potentially out of hand. And it seems like everyone involved, at least at the state level, internationally, state level, is pretty eager to keep things incremental.
Andrew, you've been watching the big crude at all? Or are you mostly focusing your days on USO right now?
I don't watch the crude. I can only watch so many things. I just watch USO as a proxy for crude mostly.
Welcome to my world, sir. Try doing 12 shows on 12 different areas of the options market and see how many things you could watch on a given day.
Hey, listen, I got that violin I'm playing for you right here. Can you hear it? Can you hear it play?
It's a beautiful tune. I love it.
But I'm just, watching that vol came up. The whole thing with the crude move, I thought, was that the volatility moves have been muted anyway. I mean, the volatility was almost twice what it is now when we had that Libyan stuff a couple of years ago. You can't even get out of the 20 handle. So for whatever reason, I don't know if it's the U.S. production or whatever, but that volatility just does not spike as much as it does. Like, I think USO, the best way is like cheap time spreads, double calendars, junk like that. Maybe even slightly short. If you wanted to short it, I think that would, to me, looks like the best way because the volatility is so low. I don't think you want to just flat out sell the contracts, but those type of trades right now, work best. And I unwound a not as good as I wanted, but I mean, with the vol so cheap, you could actually buy a straddle or a strangle into this crisis, and it paid with the vol so low. So I mean, you got to wait for a little bit, but you're not seeing what I think is you're not seeing the jump in implied vol. I don't think it jumps high enough relative to, how these potential geopolitical events could upset the apple cart. You're looking at a product like USO, and volatility right now is only 15%. And that back of the envelope is a little less than 1% a day, or like 33 cents. So you're not getting a lot of move. That's maybe $1 a day for a barrel of oil. That's not a huge number for volatility. So, the market is not pricing in geopolitical risk for this stuff. And, those oil traders are pretty smart. So they're not seeing a lot of disruption, and which usually probably means that rally we've just had, we'll probably see 6.5 or 6 again, like in a product like USO or, in crude, down another, $5-6. So I think it easily happens. It's just kind of it all, you don't look at the man behind the curtain. It's all going to go back to how it was in a couple of days. That's the way, at least I think the market's pricing the volatility right now.
Of course, oil not the only commodity we look at. And it's funny, actually, if none of that news had broken yesterday, this still would have been an interesting week to go look at the precious metals. They had some interesting developments, a lot of stuff going on out there in metals land over the last weekend. Actually, there's that whole turmoil over the silver fix and the gold fix and all the tinfoil hats, pun intended, coming out in those areas of the woods, and who's ripping people off there. And you could really go down a crazy rabbit hole of that stuff. We also saw CME cutting the margins on a lot of those products due to the pronounced sell-off in those products. Usually that's a somewhat bullish sign. People take the advantage of that to trade it up a little bit. But what we saw on the open on Monday was actually the opposite. People taking advantage of that apparently to just dump all sorts of precious metals, in particular gold. Opened up earlier this week before all the news broke on Thursday, opened up off 2.5%. It was it was the biggest drop so far of 2014. It was kind of a bit of a mystery sell-off. No one could really put their finger on what was driving it. We saw massive concentrating selling in the futures. Nearly 1.5 billion of gold futures were dumped pretty much in minutes at the open over there on COMEX, without any real, not much to really back it up. We were looking at earlier in this week, the gold in the gold futures, the Aug at the money straddle was trading right around 12.8% from a vol perspective. The SEP straddle, a little bit south of that, 12.4%. Fast forward to later this week and the big news coming out Thursday, of course, not surprisingly, gold spiking up a little bit. It jumped about 1.5% after news of that plane crash may have indeed not have been a crash, but was actually shot down. In addition to all the other news coming out of the Middle East, we saw gold take it up to the north, again to the tune of 1.5% roughly. They rallied about $20 an ounce in just about 40 minutes on the trading, with the spot gold hitting about 13.1780 over there right around towards the end of the day. And the AUG futures settling up about $17 to close at 13.1690. Of course, as a result, not surprisingly, given all this movement, this development out there, we're seeing a little bit of a tick up in gold vol. It's been a while since we've actually had a chance to say that. Gold vol has been coming off pretty aggressively over the past few months as this sell-off continued. We saw about a 10% tick up in gold vol. I know it's confusing to say a percent of a percent, but c'est la vie. So it gapped up from about 12.5 up to about the 14% range. That's what we're looking at right now in kind of the AUG at the money out there in the futures, as well as out there in GLD. Of course, as we're recording this today, listeners, GLD selling off about 0.75 percentage point here, and the big gold futures following suit as well. Jared, I know you watch the shiny stuff, for no other reason than for what to get your wife. So what caught your eye out there in gold over this past week? A lot of stuff to digest in the gold market this week.
Yeah, it was a notable move, and that move in implied vol in gold wasn't just at the front end either. You saw like 3-month implied vol was rallying too. In GLD, it got up into the kind of 13.5 range, and so the premium that's kind of been in place over the last few months between the implied and historical in GLD was pretty much erased here. And so, even though the vols are coming off a bit today, if we do see any more events that drive people into gold for whatever reason, then I think that the options may have a little bit more of a kind of a beta to the underlying metal here, as people kind of get into some bigger positions and trade around those. And you saw a similar move kind of in silver, big increase in implied vol, not in any grand sense, but back to the highs of a few months ago. And so some of the trades that people got in there, which may have just been kind of knee-jerk risk-off reaction. I certainly don't know of anything, any other catalyst that would drive those moves. Not that we can ever know for sure why people buy gold anyway.
Yeah, it's one of those weird areas. I've never known harder core bulls than all the gold bugs I've known in my life. There's pretty much nothing you can do to dissuade those people that gold can do anything short of rally continuously until the end of time. I've known a few of those in my day, and you can take any equity bull and put them up against a gold bug, and they just pale by comparison. There's just no contest. All right, Mr. Andrew, speaking of the shiny stuff, I know you love it up there in Maine as well. You're always wearing your bling, your necklaces, your gold teeth, what have you. If listeners, you haven't seen Andrew in person, it's a sight to behold with all the precious metal dangling around him. But in addition to your own jewelry needs, your own bling needs, I know you guys like to talk about GLD a lot over there in the old pit chat. So what caught your eye out there in GLD and SLV as well in this week's activity?
Mostly just, buyers and miners, like call buyers and miners and stuff like that. I think the only trade we have looked at really with any regularity has been kind of a GDX, GDXJR, off and on. We had been trading gold only really into like Fed announcements and stuff like that, looking at the positions. Other than that, though, I just find it hugely, it's just in a nowhere place for me. It's not too expensive. It's not too cheap. The volatility is real low. It's sort of just, blah. Like the fun seems to be gone out of the shiny stuff for now. So we have been looking at it and I don't think we've looked at it probably for a week and a half at this point. So it's just, it rallies on some news and then it pulls right back again, it seems like. So I don't see any real reason to own it, except for the fact that our currency is being based, I think, on a weekly or daily basis. So in that case, it's probably a decent hedge. But other than that, unless you need some new teeth, I don't know why you want to own it. But I guess there'll be people that would disagree with me. So I got to be careful because the gold bugs will come jumping through the microphone.
You just pissed off all of our Canadian listeners. I've never known any harder core gold bugs than some of the Canadian guys I used to trade with.
Than the loonies?
Yeah, and the loony. They're probably a little sad right now. Gold taking it on the chin and the loony. Not good times for the Canadians out there. Pour yourselves out of Molson, our friends to the north, and drown your sorrows. Looking here at the gold options chart, the GLD options chart, and no surprise there. The bugs still out in force. The biggest positions out here, the most actives, the DEES 130, so longer term upside calls. Surprise, surprise. 62,000 of those open a little bit nearer term, a little bit closer to home. Aug 128s also open to the tune of 53,000. And then some serious bugs out here, 48,000 of the Jan 2015 180s. Open, as well as about 48,000 of the Jan 2015 150s. I'm guessing a spread may have gone up out there, just to hazard in a guess. And then some SEP 135s. Pretty much the whole, just like VIX, the whole chain, all the top strikes, all calls until you get to the bottom. 37,000 of the Jan 120 puts open as well. So the gold bugs out in force in GLD options. Surprise, surprise. And rounding up our rundown here of volatility and volatility products, there has been some activity out there in the ags of late as well. It's interesting. There's been a bit of an evolving narrative in the world of the ags, the corn, the wheat, the beans, what have you, over the past month or so. When we started doing the show at the beginning of the month, the narrative out there in corn and wheat and those products was that they were just taking it on the chin. Yields were great. Things were looking pretty good. Rainfall was abundant. And so they were both hovering right around 4-year lows. Fast forward to this past Monday, the 14th, when those products snapped a lot of those streaks. We saw corn breaking it for the first time in 10 trading sessions, trading to the upside. So it wasn't exactly a, hey, everything is rosy, let's rally. It was more of a little bit of a break from the prolonged selling. And then fast forward even further to yesterday, to Thursday, when the news of the Malaysian crush hit. Of course, that whole Ukrainian Black Sea region, the breadbasket of Europe, in many ways, a source of very cheap grain for a lot of the world. So when that happened, news of sanctions possibly being threatened against that region, perhaps curtailing a lot of that Black Sea grain trade, that's when we saw grain taking off as well. The SEP wheat futures gapping up about 12 3/4 cents to about $5.50 a bushel. Corn also gapping up, but then giving some of that back towards the end of the day. Corn not as big of a driver in that Black Sea region. That only closed up about 0.5 cent higher on the day, and the beans also going north as well off the news. So a lot of these international macro events playing into a variety of products, not just your standard vanilla VIX and VIX options, but across the board, wheat, gold, oil, what have you. Jared, you get a chance to watch the Ags much this week?
Just a little bit. I mean, I think that the Ukraine angle, as you flagged, was pretty key. There's a little bit of kind of a slow boil story that has been around for a while, but that kind of keeps coming into relevance. Just the drought conditions in different areas of the U.S. Things are still pretty tight in California. You've had some places in like Oklahoma and Texas that have gotten a bit worse, and I think that's definitely a story that we've been talking about and watching a little bit, and I think it could sort of take on a bigger role, especially if hurricane season comes this fall and you see more volatility around weather events, and so that's something that probably deserves watching in terms of wheat and ags as well.
And Jared, I know you run your international vol monitor over there amongst the many different indicators that you compile and track on a daily basis over there at BGC. Anything catch your eye in the international vol realm, all of these macro events lighting up the tape across the board? What caught your eye amongst all those different indicators?
Well, I got to tell you, the Russia story I think is pretty interesting. And in the short term, I think it's right to kind of stick with the trend. Investors certainly aren't going to want to be holding, especially money managers, aren't going to want to be holding securities that end up getting sanctioned. Just the big four companies that were added to the list this week, Rosneft, Novatek, and the two banks were something that was already on people's radar. Those companies have been preparing for potential sanctions, but the list could expand. Additionally, just those four, energy and oil, could and the financial institutions in Russia could be added to what's called the FDN list, which is the list where you're not allowed to hold or trade or do anything with any of their securities. And if that happens, then it won't just be new debt or new equity issued by those firms, but also existing securities, and that could happen at any time. And so I think people are understandably, selling off those assets, and whatever positions they may have had left, or even any value investors who kind of got in over the summer are probably taking another look at that. That's the short term. The longer term reaction, though, is my take was that the sanctions may turn out to be less effective than the administration hoped, both because of the preparations those countries have made, the extent to which they might not rely that much on U.S. markets for funding, and just the basic fact that the government granted an exemption for any derivatives on new debt or new equity that the companies issue, which means, a creative counterparty with a big enough balance sheet and a tolerance for some of the potential future risk of litigation or whatever from the government could probably, just within the text of the law, use that derivatives exemption to do some interesting things. And so for those reasons, I'm a little bit skeptical of how much of an impact these sanctions are going to have in a strict economic way, removing sentiment out of the picture. And a lot of that, big move in the market showed up in RSX, which is the ETF on Russia that a lot of people trade, as well as in the domestic market over there. I think this is an interesting story that's not going to go away, but that, a straightforward, simple, vanilla, long volatility view might work for the short term. But, before long, we could see things go the other way or take an interesting turn that is definitely something that people might be interested to trade.
I love it. A derivatives exemption. How surprisingly forward-thinking of them in this regard. And you're right, RSX did take it on the chin yesterday, closing down to around getting as low as 24.66, rallying it back a bit today. Listings like pretty much the rest of the market, up about 2.5% to about 25.25 or so on the day. So they're rallying back a little bit in that area as well. Lots of good stuff to watch and keep an eye on. Unfortunately, that's all the time we have for the Volatility Review segment, because we want to make sure you guys get your chance to join us here on the old program as well. So we're going to keep on rolling right on into the Volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, welcome to the Volatility voicemail segment. This is, of course, the portion where you guys get your chance to join us here on the old program. Make your questions or comments heard. Like the man said, no shortage of ways for you guys to do just that. Just like our first listener, who goes by the incredible handle of George. He writes, this one's a little bit broken up. I'll have to piece it together for you a little bit, guys. He writes, I do not know whether the VIX index or the implied volatility and historical volatility of the SPY ETF can be a better indicator to make sure where the SPY and therefore the most assets are heading. How do you use these indicators together for your work? I would use other indicators too, such as moving averages, volume, underlying price, relative strength index, and other major supports and resistance levels of the underlying prices. Thank you. Regards, George. Well, great question. We obviously touch on that a lot here on the program here, George. And if I could piece the first part of that question together, if I did it correctly, he's asking essentially whether the VIX or implied vol and realized vol of the SPY and SPX and S&P in general are the better indicators. I would just say off the top of my head here that I like to use all of them. I like to use all three. I don't think one is better than the other. In general, I look at the implied vol of SPY and SPX to start off. And of course, to realize, we talk about that a lot on this show, if there's a huge schism between those two, then you know something is afoot in general. Implied should always have a premium to realized, all things being equal. When that starts to shrink, or if something else happens, or if realized does get bid ahead of implied in some rare scenarios, then you know there's some great trading opportunities afoot there. But VIX also has its place. It's something to watch. It's a very widely followed, widely watched, if not widely misunderstood indicator. It's not just the pure implied volatility of the S&P 500. Remember, listeners, there's a lot of other things thrown into that mix. There's some skew in there. There's a lot of products pushing and pulling on that product. There's some term structure baked in there. So there's a lot of other things that pull it away from just being, let's say, the front month at the money implied of the SPX. But that said, I like to use all three of those in conjunction. I'm not as big of a fan of some of the other indicators as you are here with the relative strength and others. So I think for those other indicators and how they relate back to the VIX, I'll toss it over to Jared, because he's a man who's never met an indicator that he didn't like. Jared?
Yeah, well, you could also say I've never met an indicator that I liked all that much. I like to start from the assumption that even if markets aren't maximally efficient in a really strong academic paper sort of a sense, they're pretty efficient and pretty good. And so price action reflects a lot of the information that's out there, if not every single bit of it. And so if you start with price data and kind of develop some indicators based off that, I think it's pretty tough to find really meaningful trade-worthy signals, especially at a time frame of daily or weekly data or longer. And then in the realm of volatility-based indicators, I think the same thing holds. Realized vol is just based on priced action. And while you can do some modeling at the higher end of things that I think has proven to be valuable in some cases, just straightforward standard deviation, historical volatility is not especially helpful. It's more of an indication of where we've been and where we're going, certainly. And implied vol can be better to the extent that it prices in information that people know is coming, whether it's earnings or other kinds of events. But even there, a lot of the academic studies have shown that there's not that much of a statistically significant value to be gained from using implied vol by itself. It's a tough job, in other words, to try to predict market movement, and any kind of out-of-the-box indicator, I think, is best approached with an air of skepticism.
Well said for a man who plies his trade at the research table and looks at all sorts of indicators. Always good to be healthily skeptical of everything that they're throwing at you. Speaking of hardy skepticism, he wouldn't be a New Englander if he didn't have a dose of that. Mr. Giovinazzi, what's your take here for our friend, the amazingly titled George?
For Mr. George? I don't use RSI or all those other supports resist. I don't really look at any of that stuff.
I guess you and I are just two old school options hands for that kind of stuff. We don't go for that.
I just have never seen it work. So I'm sure there's people that, can make it work. It's just not me. So I don't really do it. What I do look at is I just like basically I look at volatility charts. I'm more interested when the market moves somewhere. Either the vol moves or the SPY moves or an underlying equity moves. So, can you divine where the SPY is going from the volatility level? Not tough. I don't know anybody again who does that well. I think what you can do is you can look at volatility and maybe where the index is, and if you put some price movement and volatility movement together, you can say to yourself, is this a reasonable percentage bet to make this particular type of trade, as long as you can live with the outcome. So, support resistance, things break through support and resistance all the time. So again, I don't look at that much. I just look at, I like to see things move. I like, is the stock either a bargain and it's undervalued and there's a way to own it, or is it overvalued and there's something that looks relatively interesting to me in a way to take advantage of what I think that overvaluation is. So unfortunately, I don't have a whole lot for you on that, other than the fact, yesterday when VIX was 15, what did that mean? I'm more interested in the relative value of volats of one product versus another than just the straight up vanilla, the RSI is here. What does that mean for the underlying? I think if you want to trade options like that, it's more important to ask, where something is relative to something else, where you can kind of put some sort of edge around the idea that you have.
Yeah, I don't want to continue my anti-technical screed here on this program. I will just say this, that I don't think people realize how much underlying, professional options traders sling on a daily basis. So on many instances, the lion's share of your profits are coming from the gamma scalping that you're doing against your positions. And if you don't do that effectively, you're not going to be profitable. So I know a lot of people throughout all the pits I traded it and all the other ones tried every system under the sun that they could, every indicator, every ratio, everything they could think of to try to find some levels at which they could work their gamma scalps more effectively intraday. And pretty much every single one that was tried was eventually tossed out. The only real success we saw were the ones that were more widely followed, tended to have more orders at those levels in the book. So as a result, just by sheer volume, they would have a little bit of support and resistance at those levels. Not a ton maybe, but some. And that was pretty much the only predictive value that we saw at all of those at the end of the day. So I had a lot of my interest in and desire to use technicals beaten out of me at a very early age in the markets. But that said, if this stuff works for you, George, go for it. I would also just only add really quickly, you're asking to use these things like the implied vol to tell where SPY is headed. These aren't going to give you direction. These are essentially just showing you, like you said, volatility. So it's going to show the probability of it moving in either direction, of it just moving. So if you want to know direction, where people are leaning, what the sentiment is, you have to take a little bit of a step further. You have to look at things like skew in the underlying. That'll tell you whether people are really hedging but prepping for a big downside move. Look at the open interest and some of the strikes, the options volume, those kind of things. If you want to use options to help determine sentiment for a direction, that's a step or two beyond what you're talking about here. Since we're hitting on skew, we should get this one here from another cleverly titled listener here. Great handles this week. Anthony. He writes, this is a good one. I think you'll like this one, Jared. This speaks to your Excel foo. He actually uses that term, actually. He writes, I just downloaded the CBOE skew index data and worked a little Excel foo. I like that. The average of the skew index since inception is 117.43. It went out on Wednesday at 134.86. If my reading of this is correct, then that shows a substantial premium to SPX puts going into Thursday's correction, which says a lot of people were hedged. Question mark. Of course, this is substantially lower than the recent high of 143.26 set back on June 20th. So apparently fewer people were concerned about a sell-off prior to the actual drop. After Thursday's sell-off, the index dropped again to 131.65. That surprised me since I think the panic would spark more put buying. Does this indicate the market isn't as concerned as the sell-off might initially indicate? Well, a good Excel foo there. Anthony, I haven't had a chance to check all your numbers. I'm going to give you the benefit of the doubt that they are all correct. But it is interesting stuff. The skew index is confusing to a lot of people. It's quoted in this kind of obtuse convention that you kind of pointed out here. A lot of people have a hard time wrapping their heads around those 100 plus numbers for whatever reason. But you seem to have a good handle on it. And you're right. It does show people were hedging pretty aggressively, perhaps not as aggressively as they had been back in June, but still a large number of puts. And I don't think it's surprising to anyone here on the panel that that number would drop post sell-off and coming out of the sell-off, because look what we're seeing today. We're seeing people not being reticent at all to sell vol. The market's rallying, people selling vol. That started coming in after the session yesterday as well. People clearly saying, hey, this is not a prolonged environment. We were seeing good earnings after the close, so people were factoring that in as well. So the notion that going into a day like today when everything's rallying and people are not at all reluctant to sell vol, that number would be down a little bit, doesn't surprise me. Does that surprise you, Jared?
No, it really doesn't. This is something that had been happening well before Thursday, where investors seemed like they were pretty willing to sell upside calls, maybe not a few percent of the money, but further out of the money, on the view that the upside over the rest of the summer might be a little bit limited, especially if earnings didn't come in as well in a lot of cases as they have been. So people were, and just in terms of averages, more willing than normal to sell upside, I think, and also to buy some downside protection. When you see a kind of a wide shift in sentiment like that, it's going to push that skew index higher, even once you strip away some of those analytical layers that you guys were referring to. If you just look at the delta spread or even moneyness between 90 and 100%, 110% of the money type spread, all of those will show kind of the same thing in this kind of situation where it's not an indicator necessarily of bearish sentiment. Like you were kind of speaking to with the previous listener, it doesn't mean that the market's bearish as such. It just means that people are maybe less bullish than they had been previously and are more willing to buy protection or more willing to sell away some of that potential upside. It's hard to divine any direction from that, but it does speak to where the average investor is going. And I think that when you get this kind of a sell-off, people naturally want to monetize some of those puts that they bought, maybe buy back some of the calls that they sold earlier. And so you get the kind of offsetting reaction in skew readings. And so far, that's all been pretty textbook moves that we've seen this week.
Yeah, you're right. I mean, contrarians love to point out high skew numbers as, hey, we're heading north because everyone's hedged. So, there's a lot of ways you can chew on those numbers there, Anthony. Speaking of Anthony's, Mr. Giovinazzi, the other Anthony here on the old program, what do you have to take for our other Anthony who's writing in here?
Wait a minute. You just can't throw me in the Anthony camp because I'm Italian. There's some sort of racial thing. A name, Anthony, Andrew, it all lumps together. Dude, that's racial, man. The Italians are coming through.
My name's Longo. I can get away with it. I have a vowel.
You have a vowel. That's true. It's okay, you're Italian. What I think the problem with the skew index is that it's a flawed product, mostly because, I look at skew I look at it as the old SPX style, where I have the put curve and I have the call curve, and I view them as different. So the problem with I think the SIBO one is you always have that call versus put. Calls can be a little steep or flat, and the puts can be a little steep versus flat. So the problem with the market that we've had is that for a lot of last year and part of this year, the upside call curve was what we'll call kind of flat or real close to the money. And I think that might have dinked around with that sort of skew calculation. I mean, for the most part, I'm going to say it picks up the expensive puts, but, again, leading from the other question, it's where is that skew with a relative value of the at the money? When you're talking about the at the money of 9 volatility, it's really hard to get traders or anybody to want to sell out of the money puts on a 10 delta at a 12% vol. Considering when you blink, the at the money could be to 12%, and the skew blows up in everybody's face. So, skew index curve has a lot of natural movement just kind of based on where the at the money vol is or how that's moving. So when at the money IV is really low, you should expect the skew to be a relatively more elevated pretty much all the time. Just as when at the money volatility goes to 60, that skew value is going to be awfully low. Just because that volatility is so high at that point, it's hard. You can't really price a 60% at the money vol and then a 90% 10 delta put. It doesn't really quite work that way if you're working at 150% skew on a 10 delta put. So it's an indicator. It gives you a little idea. It's, and it sounds good that people are paying up, but those puts should be relatively expensive when the at the money volatility is so cheap. But what I say is that makes a certain type of trade interesting, like Christmas trees and iron or condors with sort of broken downside wings and things like that, where you're not paying a lot for that closer to the money put. You get to sell some downside puts against it. You have a little protection, and all of a sudden you have a trade that might make a little more sense given what you think the market's doing. And you can be right and wrong at the same time with trades like that when the skew is real steep. So it's more like, okay, what's the position, and now really what's going to really fit on it, depending on what my view is. So I look at that and I say it's an interesting index. It helps, but I don't think, for me, it's not really a useful index.
I think that might be the first Christmas tree recommendation in the 100+ episode history of Volatility Views. So mark that down in your record books there, listeners, if you're playing the home game. But you're right. It does kind of get very put heavy out there in the skew. That's kind of what the intention, that's what the review of it is. Most people who look at it think of it as a put index, even though you're right, all of us, when we were trained as market makers, call wing, put wing, two separate things. The skew index kind of conflates the two. It might be interesting down the road. I don't see them doing this, but maybe they come out with a call wing and a put wing, a separate two skew products. That'd be interesting to watch. That'd probably be a little bit more informative, but that's pretty deep in the weeds, I think. Skew index is already pretty deep in the weeds for most people. You start carving that up even further, and you get pretty esoteric. I'm sure guys like us and Jared would love it, but who knows who else would follow it. Of course, great questions, guys. That's why I love the audience of the show. You guys write in with such great questions. Keep them coming. Now we have to keep on rolling right on into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody. This is, of course, a portion of the show where we prognosticate wildly and recklessly on the future of volatility the week to come from a volatility perspective. And it seems like the vol gods are giving us a little bit of a hint, perhaps, of what's in store with what's going on right now. Most of the sell-off being retraced, the vol coming out of the market yet again. It seems like, at least in the near term, what we saw yesterday was a brief aberration. But perhaps I could be wrong. Jared, counterpoint, crossfire, let's go.
Okay, well, last week I think I mentioned we came out with our third quarter event gamma update, looking at some scenarios, some risk scenarios and other possibilities for the next several months. And this week we were, I think, right sooner and faster than we expected, both in terms of the geopolitical risk that some people were doing really well to hedge, and then also the fact that earnings have come in better than people expected. And so I can't take total credit for those because there's a little bit of luck involved, and those are all just possibilities. But I think there's plenty in terms of our crystal ball for people to be watching over the near term. Obviously, earnings could take a different direction over the next several weeks. They could turn out to be, on balance, not as good as they're looking now. But I got to say, the rate of surprises among the companies that have reported so far is one of the highest rates in the last several years. So this isn't just more of the same. And the fact that we're on a kind of no weather, no taper, no excuses kind of a quarter, and so many of these companies are still doing well, I think it says a lot. It says so much, in fact, that it kind of is pushing people toward another risk scenario for the next quarter, maybe the next several quarters, which is that we start to see really meaningful wage pressure, really meaningful job shortages in some industries. And the beige book data from the Fed this week, some of the other economic data suggested that there's some inklings in that direction in some districts, in some industries. And so if you do see more data along those lines, I think the odds of a Fed rate hike are going to get pulled forward in time. It's going to cause people to be a little bit more risk averse just on the margin here. And so some hedges that are going to be geared in that direction, I think, are really appropriate. And that's what I'm looking for. Maybe not for the next week, but for the medium term.
And Mr. Rock Lobster, take us home. What are you expecting for the week to come?
I mean, I expected lower vol this week. I mean, we got it, right? We got to.
You were correct for a couple of days.
And it's trying to get back there today. It looks like as the market ticks by. But I have to say it, I hate to be a broken record, but I think, if semiconductor companies and banks and whatever can make some money, I think earnings, usually the trend of the first week of earnings is pretty strong. That's usually how it goes. We got a good smattering already, and I expect to be more of the same. So you'll probably see stocks going up and vol coming in a little more. And I would not surprise me if we make another all-time high within the next 2 weeks, just because of the way this market goes. Since nothing has really changed in the big scheme of things, I think from the beginning of the week till now, except for global hotspots might have gotten a little hotter, but ultimately that wasn't a whole lot different than 3 weeks ago. We will probably see more of the same. I think some of the bigger issues of the U.S. being oil self-sufficient, I think low interest rates, all these things, eventually start to add up to like a longer term big positive. So, and I think we're stuck kind of in that, which is kind of a nice spot to be in if you're long equities. If you've missed the boat till now, I don't know what to tell you.
All right, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. Ran a little long this week, listeners, but of course you guys have such great questions. Wanted to make sure we got to as many as we could. But before we go, as always, let's check in with each of my cohorts here on the old Vol Views panel, see what they have cooking up in their respective necks of the woods. Starting off with you, Mr. Lobster, what's coming down the pike over there in the land of the pit?
We have our boot camp next week. Starting up. So I'm sorry, in August 12th through the 16th. So if you want to learn about volatility, how to use it, how to help you kind of diagnose market conditions and put trades on, August 12th to the 16th, go to optionpit.com/events and sign up. Probably will be the best deal you get on actually learning how to do something useful and learning how to do stuff, as we would say in some of the other shows on the Option Insider Radio Network.
So if I sign up for that boot camp, do I get to see you in a drill instructor hat and a whistle? Do I get a whistle of my own?
You don't get a whistle of your own, because that would hurt my whistling ability, because when I whistle, you would whistle. So no, I'm the only one with a whistle.
That might be worth signing up just for that, listeners, to see Andrew in his fancy drill instructor hat and his whistle. If you get bored of doing that, you can always come on our Options Bootcamp program, where that's where Dan and I do a lot of whistling and wear fancy hats and have all sorts of fun stuff there.
If people do a bad job, do you yell at them, pay me theta? What happens?
What I do is I take away their ability to comment.
Okay.
Oh, you run the band hammer on them, the ultimate.
Yes. You cannot speak anymore. No. There's no such thing as bad questions when you're trying to learn. So you got to learn. So you have to ask questions. So we do encourage questions.
That's what he says to you guys, listeners. Then he calls us, hey, you wouldn't believe this question we got yesterday. Oh, my God. And this guy named George. It was crazy.
And this other guy, Anthony, he's got to be Italian.
Those Italian guys begin with A. You can't trust them.
Not at all.
All right. Mr. Jared, take us home, sir. What's coming down the pike over there at BGC Partners?
So our equity derivatives desk puts out a daily note looking at interesting flow, trades we've seen or done, and during earnings season, looking at implied versus normal moves to kind of scout out any opportunities. And I think that's something pretty valuable that people might enjoy. I've got another issue of Volatility Tracker coming out shortly that's looking at the value of the VIX call-put ratio, something that people have been talking about a lot over the last several weeks, kind of doing an update on the predictive value there. And we just came out, as I say, with our third quarter event gamma report and discussed Russia in some detail this week as well. So a lot of interesting stuff, I think, coming out. People can give us a call if they want to kind of get on board.
Good stuff. Jared, check it out, listeners, BGC Partners, if you want to learn more and see more about what Jared and the folks over there are up to. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and for downloading the mobile app, and of course for writing them such great questions. Good job, Anthony and George and all the rest of you. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at at 773-669-4VOL or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.